Well, good evening on this Wednesday, the 29th of November. This is the last webinar of 2023 for Rand Swiss. I'd like to thank Pascal and Gary Boyson for the opportunity to actually bring you my ideas for the fourth time this year. It's been a very interesting year in terms of anyone that works, invests, and covers the JSE. And I think I've just been updating my data points as until earlier today of my top 9, and of course the underlying indices that we all really care about. And I think what is really interesting, particularly in the last 30 days, which seems counterintuitive, given that we're probably all, to use a very Afrikaans term, we're all cutful of Eskom, the economy, interest rates, higher food price inflation, and everything that we all have in our daily lives that makes it slightly misery. The underlying markets in the last 30 days have actually been extremely good. As of a close of business today, looking at my data points, the JSE All Share is up just, is up about 8%. The small cap index is up 6.5%. And the mid-cap index is up 6% just in the last 30 days, showing you that despite all the doom and gloom we have in this country, and us lighting candles every evening and getting out our gas stoves to warm up our food, there actually are pockets of excellence. So it got me thinking, why would that be? Why, when everything is so gloomy in this country, there would be pockets of excellence in certain aspects of the stock market? The Rand has been somewhat volatile from its worst, which was just under 20 Rands to the dollar. We're now trading at around 18.58 when I checked slightly earlier. And in the last few weeks, I've been through reporting season. And I have to contend that results on whole have been actually fairly good. There have been pockets of stocks which have disappointed, but disappointed not to the extent where we have seen major sell-offs. And I'll give you a few examples in this 1 hour. And the Q&A chat box is open. So as Pascal would say, get your questions in. And if it is time towards the end, and I'm able to answer those questions to the best of my ability, given that I've been out pretty much all this week seeing companies, I will gladly respond. I was actually at Carp Agri earlier in Paarl, and it was pretty hot. And on Monday, I had lunch with Reunert for their recent year-end 23 results. And then I've also had the year-end results of Oceana, and I had a one-on-one meeting with a company yesterday. So I've been through a swathe of reporting seasons, literally in the last few days, and it ain't over yet. I'm looking at my diary, which is just to my right here. And it's pretty packed up until, I think, the 6th or 7th of December. When the last result I have in my diary, I believe, is the year-end results to September for asset management company Signia. Now, if you see me reaching for my lemon water, please excuse me. And if you hear the dog in the background, he's probably just barking at some dogs walking in my street. I've got a bit of heartburn, so I'm drinking lemon water. So apologies if I take the occasional sip. But as you all know, the last chat we had probably a quarter ago was a fireside chat because we had load shedding where I was staying, and it was all done in candlelight and the dim glow of a wood-burning fire. Tonight in Cape Town, the sun is shining. It's slightly windy, but hopefully I'll keep this conversation going unless my voice gives out. So I wanted to start, as always, with a very quick update of my top 9 stocks of 2023. Which, as I update right now, is substantially once again beating the underlying indices. The 9 shares for refresher were Assupol and TWK on the Cape Town Stock Exchange. CA Sales, which has been my top performing stock year to date, up 51%. Kuro Holdings, the best performing education stock so far this year. Carp Agri, Nampak, Novus, Mustec, and York Timbers. There's been a fairly mixed bag, with the best performing stock being CA and S, up 51%, and the worst performing stock as I updated earlier, being NAMPAC down 14.63%. The NAMPAC results should be out in the next week and a half. I think it's the 4th of December from memory. And you saw the trading update, which came out yesterday, which in my mind is completely academic, because having undertaken a large rights issue and material restructuring currently on the go by CEO Phil Rue, the key importance to NAMPAC will be the presentation that Phil will give in the next week or so, detailing what has been cut and burnt at NAMPAC to try and right-size the ship, what deals have been done to raise further money, and what the timeline will be to get this business back on its feet, profitable, and hopefully the share price to keep running. So let me run through some of the highlights. So my entire top 9 to date, as of when I updated this slightly earlier, it was up 7.69%. The small cap index year to date is only up 0.73%. The mid cap index is trailing, down 2.89%, and the all share year to date is only up 3%, showing you, as I indicated earlier, the gains we have seen in the last 30 days have materially turned around some significant negatives in the key indices that I track. So I'm going to run through a couple of interesting little tidbits. I'm actually up in Johannesburg on the 11th and 13th of December, just seeing a good handful of companies before the year end. Any of you that have tracked my institutional work for many, many years will know that I spend pretty much most of December kicking the tires, visiting many of the companies that I cover very closely, and some which I think could be interesting wild cards into the new calendar year. And I go and visit the companies to ascertain, would they be worthy of inclusion into my top stocks of 2024? And as Pascal said to me earlier, Anthony, have you selected your top stocks of next year? And I gave her a very cheeky smile. I said, maybe I have. Maybe that many of the stocks have already been selected, but I shall sit back until everyone is back at their desks in 2024 and then publish to the whole world at the same time what this list is going to be. So keep an eye out for that. I indicated earlier that my top performing stock year to date has been CA Sales. I'm actually meeting Duncan Lewis, the CEO, in Johannesburg for an update on the 11th. And this stock has been a completely remarkable performer. For those with memories, I actually recommended this stock back in October 2022 at about R5.34 after the unbundling from PSG occurred and the stock had calmed down from an extremely volatile trading period. At one point, the stock was trading north of 17 Rand in very, very thin volumes. And I was warning my institutional clients to actually stay away until the PSG unbundling had actually occurred and the underlying trading of the stock had settled down, which it did in September and October last year. Then in January 2023, I chose the stock as one of my top 9 of the year at R6.40. And it's not held back since. Interim results were exactly in line with my expectations. Very strong growth in operations, predominantly in the SADC region. South Africa was quite weak, but the key growth vectors in CANS continue to be in the SADC region, which is Namibia, Botswana, Zimbabwe, Zambia, and at some point they'll be opening up offices in what I call the East African region, Rwanda, Kenya, Tanzania, Uganda, etc., where they see significant growth. When I chose the stock at the beginning of this year at R6.40, I set a target price of R8.50, which is good gain. It made that share price as of early September after the interim results came out. After sitting with the CEO at a coffee in Cape Town, and for any of you that track my movements on social media, it's quite easy to ascertain where I am at any one point in time. It's varying coffee shops around the Cape Quarter and around Claremont. And you would have seen me and Duncan Lewis alongside the PSG corporate broker having a general cup of coffee to chat about prospects for the second six months of the year and prospects into 2024. And Duncan said to me, Anthony, well, we've made your target. What now? And I said, well, do you want to know what my new target is? And he looked at me and goes, of course I do. And I said, well, it's 11 Rand 50. And he looked at me quite quizzically. He said, do you believe you'll make that? And I said, I think you'll easily make it into 2024. And he looked at me back and he says, I think I'll take a bet with you. I said, what bet will that be? I said, I think you'll be wrong. I said, really? I said, why do you think I'll be wrong? He goes, because I think it'll be higher than that. And I said, I'll stick with my 11 Rand 50. If you make 11 Rand 50 and the stock was 8 Rand 60 when I saw him in September, I said, I will buy you lunch next time I see you in Cape Town. So I'm very fond of taking bets with the CEOs of many of the larger companies that I cover. One, because it keeps me on the toes. And two, I like to put my line in the sand so that my corporates and my institutional clients know that I actually have conviction behind many of the stocks that I actually cover. Today, I'm going to clock watch. I've got my little clock next to me, and I don't want to ramble on too long because Pascal said, please have time towards the end of the session to ask some questions. So once again, I will remind you to try and send any questions through, and if I can answer them, I will. In many cases, perhaps the sensitivity of the stocks in question may not encumber me to give you the answers you may wish, but I will try my best as they start to come on through. The other stock that has been a compelling performer in my top 5 has been Novus Holdings. Now, Novus Holdings is a really, really interesting stock. Market value the last time I checked was circa 1.2 billion Rand. And I want to go back in history. Its current share price is 4 Rand 29. I've had a buy in this stock since a Rand, purely because activists under A2 Investment Partners, run by Adrian Zettler, formerly of Coronation, and Andre van der Veen, who's formerly a senior executive at Hoskin Consolidated Investments, started their own activist fund. And their first foray was into Novus, then into York Timbers, which has not gone as well as anticipated, and latterly into Nampak. Novus has been an outstanding success for this company. They now own circa 64% of the company, having done a minority offer to institutional shareholders quite some time ago. I figured about 2 Rand 35, and they've also paid out substantial dividends to remaining shareholders and, of course, themselves. Now, they actually had a trading update out a few weeks ago, and then a revised trading update came out a good week ago. I actually met with the company last Friday just to discuss the interim results. Now, this is a company that was called badly short in 2022 because of the Ukrainian and Russian crisis. International prices of all commodities went through the roof, not just soft commodities like wheat and corn and soya, but hard commodities as well, like oil, paper, and even fish went up because anything that Russia supplied, which enacted sanctions from a global community, saw significant increases in prices. Because Novus was at that stage importing most of its paper and pulp requirement for its substantial printing and publishing business, when the international price of paper went through the roof, they were caught. They had to buy to meet their requirements because the domestic market for the supply of paper was basically tied up with existing contracts with existing players like Caxton CTP. So they were forced to basically either can contracts or print for their customers and make a loss. That situation, thankfully, has reversed. And as you saw in the recent interim results, the HEPS loss the company had has now reversed into a profit of around roughly 28 cents a share. Now, at its peak, Novus was making roughly 56 cents a share last year and was trading at a bargain basement PE. Another interesting tidbit, before A2 Investment Partners got involved in buying its stake, I think they paid, from memory, a Rand. The market value of Novus was trading at such a deep discount. The cash inside the company was worth nearly triple the underlying market value of the company. So anyone that says that the market knows everything and that all the information is in the public domain which it often is. But in the small to mid-cap space, a lot of the nuances, which analysts like me spend our lives digging and visiting companies and kicking the proverbial tires. And I'm sure if Jason is listening to this webcast, he often teases me saying, Anthony, kicking the tires, isn't that a bit old-fashioned? And I say, Jason, kicking the tires is only the way to understand a company. And in Novus's case, there was a company trading in an unfashionable analog space, printing and publishing leaflets and newspapers and books. But the underlying cash in hand was significantly higher than its underlying market valuation. Activists saw this, they swooped, they took the stake out from Media24, roughly 18%. They then took another stake out from other players, and the activists now own 64% of the company, and the company is now back in profit, and it's also undertaken a substantial transaction. Earlier this year, it bought the old Pearson education business, which is one of the largest book providers into the education system of the state or the education departments. It's a multi-year contract, and it's very, very profitable. So if you start encompassing the profitability of Pearson Education, which has been renamed MMS, with a recovering printing and publishing business of Novus, I had a target headline earnings per share of the stock of R1. This was when the stock was trading under 3 Rand, and everybody thought I was smoking my socks. And I said, well, Pearson could easily bring 50 cents a share to the party once the debt is repaid. And if you look closely at the recent interim results, the debt is rapidly being repaid from the good cash generation inside Novus. We've now seen a recovery in the printing and publishing operation, earning 28 cents. And if you annualize that, we start getting back to the numbers they had last year. So my 1 Rand in earnings for the next 12 months does not look out of form. And as I get my little calculator here, which is how I like to work, if we take the current share price of Novus with my earnings expectations, that puts it in a price earnings ratio of 4.3 times. Now, I'm sure many of you will say out there, well, Anthony, there are many companies out there which are trading on very low PEs of below 6, some even lower than Novus. Argent Industrial, which I'll talk about shortly, is trading on a price earnings ratio to my forecast of around 3 times. You've got Baldwin also trading at very low multiples for different reasons, because the property sector is clearly not in favor. But going back to Novus, I've written on the stock consistently so far this year. For those with memories, and it's all on public record, in July, I had a buy the stock in the Financial Mail at 3 Rand a share, with very much the same information I'm giving you right now. Then in, I think, July, it had reached about 3 Rand 60. Again, I reiterated my strong buy recommendation, and it then got very, very frothy. It reached a high of about 4 Rand 30, and I issued a short-term sell, and the share price fell back into the high threes. I think 370, 380. And again, I went out with another buy, and today it's trading at 4 Rand 29. I have a target price of Novus of 5 Rand 50. And I would not be surprised, I haven't confirmed yet, if the stock is carried over into my 2024 top stocks, because the underlying recovery in printing and publishing, and specifically the growth in MMS or education publishing, and the new ventures they intend to roll out, particularly using artificial intelligence and the massive back catalogue they have in education publishing, which they can put online. And we all know that everything is going online these days. Imagine how powerful a company would be if at your very fingertips, on your cell phone, on your tablet, on your PC, that every single educational textbook that you would need for your primary, secondary, or tertiary courses were to be online. That would be of significant benefit to a company like Novus, because you do not have to then buy paper, run the printing presses, you just update the digital applications which is far more cost effective than printing books on a yearly basis and paying people to actually do that. Bear that in mind. Sometimes moving from analog to digital does take time and cost money, but once it's done and it's there, and it becomes very profitable. So I would certainly keep a very strong eye on Novus at 4.29. It is the second best performing stock in my portfolio, and I think some of my institutional clients are only now beginning to prick at their ears that perhaps Novus, which was deeply unfashionable, could suddenly become one of the interesting stocks in 2024 if their artificial intelligence and the digitization of their back catalog actually starts coming into fruition. So not everything in my garden of top stocks is rosy. There are some bum stocks, and I will always go through those to give a context. Once again, excuse me having a sip of my lemon water. One of my biggest bum stocks has been York Timbers. At one point, I was making very good money. I chose the stock this year, £2.02, and at one point it was up, between 5 and 10%. We're now down 10% for the year, and that is all down to a conscious decision by the company to extend the biological assets of its underlying forestry business. What does that mean? I'm not going to spend too much time on York. It means that trees are normally harvested at around 18 to 20 years. You get a certain price, but if you leave the trees in the ground slightly longer, the maturity of those trees means you get a bigger, denser, more valuable log. The tree grows and you get more linear meters of timber out of that tree. So by York extending its biological asset by 2 to 3 years, there is a short-term hit to underlying profitability because they simply aren't harvesting their own trees. They're having to buy in logs from competitors or the state-owned entity called Safcol. But at some point in the next 2 or 3 years, their entire plantation will be bigger, the trees will be older, the lumber will be far denser, and the linear meters will be significant. And the price differential you get from harvesting a 17 to 18-year-old tree compared to a 20 or 23-year-old tree can be between 30 and 100%, showing you that perhaps leaving things growing in the ground a little bit longer can pay you dividends. I coined the term in a Financial Mail article some months back on York, but sometimes money just does grow on trees, but it just takes slightly longer to get that money harvested. So York, sadly, has been one of my bum stocks. I would not be surprised if in due course the activist shareholders perhaps make another cheeky offer, a bit like they did with Novus, to buy out minorities. I'm a York shareholder. I'm losing money alongside you if you bought the stock, but I'm certainly not selling the share because I believe that the underlying state-owned industry of Safcol, which is the state-owned forestry company, a bit like every other SOE in this country, like Transnet, Portnet, Eskom, you name it, is also falling in a heap. And at some point, the private owners of plantations and timber in this country will actually make some very, very good money because the state will be unable to provide the timber needed in the construction, export, and mining industries. So the likes of York Timbers, TWK, and some of the unlisteds should do quite well. And that ties quite nicely into another bum stock in my portfolio, which was doing extremely well, but due to very weak year-end results to August, which came about a week ago, the share price has fallen from 52 Rand to 44 Rand 98. So if you include the dividend paid, it's down about 12%. And that's TWK. TWK, sadly, was caught by the fertilizer crisis. They sell about 10% of all the fertilizer in this country because they're importers. And they then sell that imported fertilizer to their farming clients. As they were buying fertilizer to be delivered from offshore, not only were they caught by the international price of fertilizer falling as the stock was on the water, but as it got to ports in this country, we all know that Portnet and Transnet isn't exactly the most efficient entity for getting supply chain logistics from point of port to point of need. And they just got caught. They couldn't get the product from a port to their customer fast enough or unload it. So it was a double whammy. They lost money on the water, and they lost money at the port, and they lost money at the land. See, even though the bulk of their business comes from timber, regarding exporting wood chips to the paper and pulp market in Southeast Asia and Japan, they were caught on the fertilizer side, and that cost them basically 180 million rand. Having discussed this with the company last week, they expect a normalization of the fertilizer business in the next 12 months. The rand has weakened year on year, and they expect some nice growth in the underlying export market for wood chips into the ongoing paper and pulp market in Southeast Asia and possibly into Europe, again because of Russian sanctions. The Russians are one of the largest suppliers of timber products alongside the Scandinavian countries. But with Russia out of the market, the world is looking for alternative supplies, and TWK is well placed. So at 44.98 rand, the stock is down 12%, but it's one that I will certainly hold because it's been one of the top performing agricultural counters for the last 5 years. You could have bought the stock 5 years ago for around 7 rand a share. It touched 60 rand earlier this year. It has been the top performing agricultural stock in the entire basket of stocks that I cover. So I'm certainly not going to turf it out because it's had a bit of a bum steer purely because it got caught short on the global decline in the fertilizer sector. So I'm now going to move on from my top stocks to talk about some other things which look potentially interesting. So this can do that and go in the bin. I'm now going to talk about a stock that I've discussed on this webinar many, many times, and a stock that will be familiar to many of you, Afrimat. I've covered this stock since 2016. And if any of you out there are now rolling your eyes and saying, here he goes again, talking once again about a stock which he keeps talking about, why the hell is he wasting our time? Let me tell you why I'm wasting your time. I'm wasting your time because you could have bought this stock on the 26th of October, which is exactly a month ago, when I put out a buy recommendation at 50.95 rand, when the trading update came out, which was exactly in line with my expectations, where I expected results for the year to be flat to up maybe 4%. They were up basically in low single digits. The market thought the stock would show a decline in earnings. I certainly did not believe that in the extensive work that I've done in this company for the best part of now going on 17, 18 years. As I sit here right now, the stock's market value is 6.1 billion rand. Year to date, it's up 13%. The share price is 57.99 rand. But here's the interesting point. Sometimes being an analyst is all about timing. And to go back to what I said at the start of this webinar, for anybody that thinks that all the information is always in the market, it's not. Afrimat in the last 30 trading days is up 14%. So if you would have timed this nicely, you would have gained 14% on an investment, which I still believe has significant upside legs. So why do I think that Afrimat, despite having risen 14% from my known buy recommendation, which was in the market and commented on in an article in the Financial Mail a good month ago, why has it still got legs? Well, I'll tell you, my target price remains 80 rand. It's been 80 rand probably now since late August, September. The benefit, as I've said to you on these webinars before, is going to annual general meetings. And I will keep on preaching to you that anybody who has not gone to an annual general meeting, which is a public forum, whether you're a shareholder or not, because you can sign in as a guest, and it's very unlikely that anyone is ever going to kick you out if you're not a shareholder, because nobody ever goes. Afrimat gave their AGM in early August. I was one of the very, very few participants of an annual general meeting. And the CEO, Andries van Heerden, and his executive team succinctly laid out why this company was doing better than market expectations, why the earnings guidance wouldn't be as bad as then market expectations, and what the prospects for this company were going forward. So again, if you'd been to that AGM in August, when the share price back then was trading probably in 45, 46, 47, 48 Rand, you would have done quite well, given today it's 57 Rand 99. One more sip. I take these sips for dramatic effect. So what is going on inside Afrimat, which makes me excited, and particularly my institutional clients excited? Unfortunately, I can't name names of my institutional clients, but I can tell you that of the top 40 institutions in this country, I would say that pretty much all of them are my clients, excluding the PIC, who I have no interest in dealing with. Some of my clients in the last week have started participating in Afrimat. They're seeing what I've been seeing for the best part of 3 months, which has recently been galvanized by the interim results which came out. And even though interim results were fairly pedestrian, only up 4% for the period at 263.4 cents a share, there were some very, very interesting dynamics going on inside the company, which the market failed to pick up on. They're now picking up on them. And I'm going to lay them out to you in a very clear and concise format, and you can write them down and hold me to account. And I've written them down on my little pad here because I actually gave this exact summary to my single largest client an hour ago because he asked me to. He said, Anthony, what's going on? Why do you like the stock? I said, point number one, the single biggest growth driver inside Afrimat in the next 12 to 18 months will come from Unkomati Anthracite, an operation which I visited late last year with institutional investors. At the interim stage, which we've just reported, they had a loss of 21 million Rand. At the year end to February 2023, the company made a profit of just under 20 million Rand in round numbers. And that doesn't sound very exciting, does it? Here where it gets very exciting. The reason why Unkomati made a loss in the first 6 months, despite in the comparative period last year, making a profit of just under 21 million Rand, was all down to a combination of localized community factors and some geological issues which had to be resolved. Regarding the community action, some blasting that took place in the Unkomati mine, under the rules in this country, if there's a local township or a community living near the mine, if there is any rock that potentially gets too near to the housing has to be demolished and the entire community relocated further back. So there were community issues because many of the local community were encroaching on the mine's operations. I wouldn't say illegally, but perhaps they realized that if they built their house too near to the mine and there was a rock blast, Afrimat would be obliged to buy their house and then build them a new one a few kilometers back. And quite a number of residents in Unkomati have got nice, shiny new houses the last few months. That delayed and cost the company money because they couldn't actually work at the mine because they had to relocate certain community members, which again is the right thing to do. Safety and security is paramount in any company's life, particularly Afrimat. A second issue is the underground shaft, which they had sunk, hit a dolomite inclusion, which basically meant that a very hard lump of rock was suddenly in the way of a declining shaft. And rather than going through it, which would have been very time-consuming, very expensive, and somewhat dangerous, they went around it. That took time and cost money, which is why Unkomati did not make its scheduled tonnage in terms of production, and lost 21 million rand in the period. Unkamati is scheduled to see its anthracite production increase from round numbers 360,000 tons to 600,000 tons in the next 12 to 18 months. Now, I mention these numbers specifically for the following simple reason. To date, Afrimat has spent roughly R500 million in capital expenditure in developing and rehabilitating that mine to get to the current level of production. And it is making, round numbers, 20 million rand a year. But the costs have been sunk. There's no more capex, there's just maintenance. They can now start sharply increasing the underlying mining of anthracite because they're the guaranteed buyer in the international trading house of Glencore at a set guaranteed price fixed for 5 years. So they have line of sight, but whatever they mine, there is a guaranteed buyer at a set price. And Afrimat makes roughly 800 rand a ton in profit on every ton it mines. So as I said to you earlier, if they make 20 million rand on 360,000 tons, but it's been, there's been a cost of mine in establishing. If they suddenly go to 600,000 tons, start doing your mathematics. The differential becomes very, very material. If this mine starts producing 600,000 tons a year at an average 800-ton operation, do the mathematics, 6 8s of 48. Potentially this company, this anthracite operation, could be making north of 400 million rand a year. It made 20 million rand last year. You divide that by the number of shares in issue in Afrimat, you're going to easily get between R1.50 and R2 a share. And as I told you, at the interim stage, they earned R2.63. And for the full year, they earned roughly, where's my numbers here, R4.57. So Unkamati could become an extremely profitable mine to Afrimat in the next 12 to 18 months. Point number one, the institutions have suddenly cottoned on to that. Point number two, Lafarge. Afrimat paid roughly R1 billion in round numbers to buy Lafarge, the country's #1 quality provider of aggregates, and it also has a cement business with an installed capacity of around, call it 1.5, 1.6 million tons. Cement is not exciting. What's exciting inside Lafarge is the underlying aggregates, which will make Afrimat the leading player nationally in the supply of aggregates. Back in 2021, Lafarge, in its heyday, when it was run by the French, was making 331 million rand a year. In 2022, and a combination of load shedding and the fact that French wanted to get the hell out, profit dropped to 38 million rand, which is the equivalent of roughly 3.2 million rand a month. Let me just double check that, just so I'm sure. Yeah, 3.2 million rand a month. Afrimat paid R1 billion for Lafarge, but inside the company was 200 million rand of cash. So the net effective price is 800 million rand for a company which has revenue this year of 4.5 billion rand and a suboptimal operating margin. Now, anybody that's followed Afrimat for the last 15 or 20 years will know that every single acquisition this company has done, from Glenn Douglas way back in the day, to Cape Line, to Clinker Group, to InfraSource, and many, many others, they have turned round unprofitable mines into highly profitable, efficient entities. There is no reason to believe that the same Afrimat magic cannot be sprinkled on Lafarge. At the results presentation, I asked the company, I said, even though you don't formally own it yet, and the Competition Commission is literally on the verge of giving approval for the transaction, I said, how are underlying operations at Lafarge? and it was discussed it is now making 12 million rand a month. So it's gone from 3.2 million when they bought it to 12 million a month. That's a near 400% increase, and they don't even own it yet. It makes you wonder how much money they will make when they get their grubby hands on it, actually get some efficient equipment in there, start improving the logistics and the operations around the country. They believe that they get back to an average operating margin of around 8%, which is still a discount to the margin that Afrimat gets on its core construction materials operation. This business, in the first couple of years, could make between 250 and 300 million rand in profit. Once again, you start dividing that by the number of shares in issue in Afrimat, you can easily get between R1 and R1.50. So you add that to the money from Unkamati, you can quickly see that anything between R2.50 and R4 can instantly be achieved just from two deals, Unkamati and Lafarge. You then start adding in the uplift from the increased iron ore price that Demeneng, the export business, gains. I was doing some work yesterday in a published note, actually on Afrimat, and the iron ore price in the last 3 months is up 32% in dollars and 28% in rand. So if you're exporting circa 900,000 tons a year and your price has gone up 32% in dollars and 28% in rand, you know that you're going to have a very good second half results coming your way. The reason why Afrimat hasn't run as hard as it should is its earnings on iron ore are mostly capped. Its only export operation is 900,000 tons on a fixed line to Saldanha. So someone like Kumba, which has a much higher allocation of an export rail, will benefit far more significantly from a rising iron ore price. Afrimat won't, because it has a fixed allocation on Transnet. So if Transnet ever gets their arse in gear and gives greater allocation to the iron ore exporters in the Northern Cape to Saldanha, Afrimat should see an uplift in its underlying allocation, and you then watch the earnings of this company on the iron ore side regarding exports if the price holds. Why has the iron ore price been so strong? It's up from $98 to $130 because the Chinese government, who are the single largest buyer of iron ore globally, is looking to stimulate their moribund, weak economy to try and prop up a failing property market and a flatline construction market. They will do that by pumping money into the system regarding cheap loans to the property and construction sector, which will then stimulate iron ore demand and steel production. China produces approximately 1 billion tons of steel a year. That's why the iron ore price has been running on international hopes that China will stimulate its economy from its current moribund state. The reason why Afrimat hasn't fully benefited in its share price run compared to Kumba, which those of you that follow me on Twitter on SmallTalkDaily I've commented on, where Kumba has materially outperformed Afrimat, is most of its exports of iron ore is for the export market, where Afrimat only about, call it 30 or 40%, goes to the export market. The majority of Afrimat's business goes to ArcelorMittal in a fixed price contract, and that contract is cast in stone. Now, the reason why I published a note yesterday is those of you that may have seen the ArcelorMittal share price falling in a heap yesterday was because they announced that certain steel products at their Newcastle operation would be wound down. Now, my first thought was the market's going to get a fright that Afrimat, which has a supply agreement with ACML, will see lower volumes in its inland operation, and as such, its cash cow, which is Jenkins, will get affected. It took me the best part of 2 minutes to ascertain that there is no impact whatsoever from ACML curtailing the cancellation of the production of certain steel products at Newcastle. So as far as I'm concerned, iron ore is doing pretty nicely, thank you. So between Unkamati anthracite, Lafarge, and iron ore, Afrimat at 57.99 to me remains a buy. And I think the wider institutional market is beginning to realize that the underlying simplistic metrics, which I've explained to you, and I've given you exactly the same information as I've given my largest client an hour ago. It's all there for the market to see. And I think once the second half results come out, and once the company starts issuing its guidance into 2024, I can see the stock having a nice run. So I have a buy recommendation on Afrimat. I have had since 50 Rand 95, and my target price is 80 Rand. I'm taking another sip. And I want to go on to two other stocks very briefly. I see it's 7:15, and I will lay some time for questions and answers. Please, there are quite a lot coming in. Okay, I didn't scroll down. So, okay, there is a few, and I'll get to ones that they tell me to answer. Another really interesting stock. I was in Paarl today at Carp Agri. Now, I mentioned earlier that Carp Agri is one of the stocks in my top 9 portfolio, and year to date, it has been negative. It's down roughly 10%. Recent interim results showed an 11% increase in HEPS, to 6 Rand and 18 cents. They paid a 1 Rand 80 dividend, which was the stock on the close of market today on a price earnings ratio of roughly 5.8 and a dividend yield of 4.9 times. As I said to my clients, I said, you name me a retailer, any retailer of consequence that has shown an 11% increase in its HEPS in this extremely difficult operating environment and still has significant prospects into 2024. Despite the economy, despite load shedding, despite all the issues I've named earlier regarding the fragility of a consumer. So having met with Carp Agri this morning in Paarl with the CEO, Sean Walsh, and the Chief Financial Officer, Graham Sim, I walked out extremely positive on my underlying guidance and buy recommendation in Carp Agri. And again, some of my institutional clients asked me for feedback on my meeting, and I told them exactly what I'm about to tell you. So there's full transparency here regarding the narrative as to why I'm recommending Carp Agri, which is currently trading, looking at my pad here, at about round numbers 36 Rand. Point one, roughly 85 to 86% of this company is derived from retail, but not retail as you and I would call it. It's not the likes of Truworths or a ShopRite or a Pick and Pay or a Lewis Stores or an Ellereens. Their retail comes from a combination of agricultural products, DIY, fuel, convenience store sales, and the like. But it's still retail. Retail is retail. They did a very large transaction in November 2021 called PEG, P-E-G. We would pay just over R1 billion to buy a number of very large fuel stations around the country on the major highways, Joburg to Cape Town, Joburg to Durban, etc., where you stop off in these large ultra cities, etc., to fill up your car. You want to buy something to eat from one of the fast food forecourts, stretch your legs, use the bathroom, go to the shop, etc. And the prices at these locations are never the cheapest because they're the only location for miles around, or should I say kilometers around. That business has outperformed. Unlike the greater fuel market in this country, Carp Agri in the last 12 months had a net growth in its underlying retail volumes, despite having PEG in its base. Stripping out PEG, they still saw a net increase in fuel sales. The convenience stores are still doing very, very good business, thank you. What has picked up in the last couple of months is the agricultural side of Carp Agri. Even though it's less than 25% of the overall business in terms of sales, their Agrimark stores in the last results period to September were basically flat. However, we are now going into the key growing season here in the Western and Eastern Cape. For those that know, we've had very, very good rains in the winter down here. All the dams are full. The climate is ideal, and the fruit farmers and the wheat farmers are looking forward to a very, very healthy harvest in the next year or two. The rand has also weakened like on like, and the ports, despite what you may have read regarding their, I want to be polite here, about their level of inefficiency. The Cape Town port is inefficient. However, the fruit farmers and the fruit operating companies that I speak to are working very closely with the Port of Cape Town. There is now a dedicated berth for fruit exports. New equipment and machinery will be brought on board to make sure that these fruit exports, which are key to the agricultural exports of this country, and particularly the Western Cape, and more importantly, Carp Agri, will get out in the next 12 months. I'm also told that the table grape market this year will be 8 million cartons higher than last year. Now, 8 million cartons at 120 rand a carton means R1 billion of extra revenue going into the underlying agricultural value chain. That means more requisites, more packaging, more everything bought by the farmers. The wheat harvest this year will be the second best on record at 2.2 million tons. 53% of all the wheat grown in this country is grown in the Western Cape. That's the Carp Agri heartland. So they are expecting a very good season from their agricultural operations for the year end of September 2024. And they are reasonably confident of a 20% growth in earnings from a 6.18 Rand base this year. I already had 7 Rand to 7.25 Rand in my base for September 2024. So let's get my little calculator out again. That puts the P of this stock at under 5, with a good dividend yield. And the other sweetener is the debt they took on board to fund the R1 billion transaction of PEG, of which 400 million Rand came from the sale and leaseback of some properties. So the net debt was 600 million. They've started to repay that back very quickly. And I anticipate by the close of the next financial year, to September 2024, another 200 million Rand will be paid off. And given that interest rates in this country have been the killer to many earnings reported by many small to mid caps, any reduction in finance costs will just throw flew into the bottom line. So for Carp Agri, I see their retail operations doing low single digits in terms of revenue growth, high single digits in terms of profitability. The agricultural side is recovering fast, and the underlying interest costs inside the company should also start to come down, and they have tightened their underlying costs, and there's no material capex inside the business. At 36 Rand on a PE to September 2024 of under 5, and I've covered this company for the best part of 20 years. It's also the 5th biggest stock in my personal pension fund. I think the stock has significant upside. It has been range bound the last 12 months for 2 simple reasons. Those of you with memory of the market will understand that February 2022, Zeda unbundled its 42% stake in Carp Agri, which caused a huge liquidity event in the marketplace. On that liquidity event, PSG also gained a large stake in Carp Agri. PSG itself unbundled its underlying assets in September 2023, leading to another significant liquidity event. So Carp Agri, which only has 74 million shares in issue, has been through a period of extreme volatility regarding liquidity, which is only now beginning to calm down. We did an odd lot buyout a short while ago. It didn't buy back significant numbers of shares, but it did clear the tail of the people in the market that owned one or two shares. I would not be surprised if in 2024 the company considers doing much the same. I do not foresee significant share buybacks until the PEG debt has been repaid down to equitable levels, perhaps in 2025. I will then see the money that Carp Agri saves from the interest payments on the PEG deal and the profit that PEG makes being used to, one, fund higher dividends to shareholders, and two, undertake share buybacks. Now, for a company in the retail space, which has a dividend yield, as I said, to forecast 2024 of around 6% and a price earnings ratio, round numbers 5, I think that is a compelling buy. I've had a target price in the stock for quite some time of 44 Rand. I'm going to be upgrading that in the next few weeks to 48 Rand. And my ultimate target price of the stock is 54 Rand. And I think I would say that for those that have access to the share register, institutions having kept an eye on the stock in 2023 because of the liquidity events pertaining from Zeda and latterly PSG, are now saying, you know what, this stock looks good value. The agricultural cycle is turning up, and it actually is a retailer. I call it Carp Agri. Its actual name is KAL Group. So I think KAL Group at 36 Rand, for me, is one of the better stocks in the mid-cap universe that I would certainly consider for any long-term growth portfolio, and it'll enable you to sleep at night. It is now 7:25. I've rambled on. I've given you, hopefully, some very interesting ideas in some quality mid-cap stocks and a couple of small caps that will be of value to anyone that wants to build a portfolio of quality growth shares on a 12 to 24 month basis. I have high conviction in all of the stocks that I've recommended. I want to talk about Argent Industrial in closing as a small cap. It is trading at around 15 Rand a share. They recently had earnings up 23% to 2.22 Rand. I have 5 Rand of earnings in the system to to March next year, which puts the stock on a PE of around 3 times. This is a company that in the last 5 years has bought back shares, which have reduced from 88 million down to about 56 million. They're still buying back shares and they pay a reasonable dividend. Their offshore operations in the recent interim results are now roughly 74% of all the company's profits. So it's a great Rand hedge. The net asset value is 28 Rand in round numbers. It is trading at around 15. So it's trading at a significant discount to its net asset value. I spoke to the company after results. They have an offshore order book in the UK of over £500 million in just one of their divisions. They sit on net cash held offshore in dollars, pounds, and euros of 300 million Rand, and their current market value is 850 million Rand. I put out a note to my clients a few days ago stating the following. If you took the cash out of Argent, you have a company round value worth round numbers then of £500 million. If they were ever to sell just their fuel business called Fluid Transfer and Fuel Proof, which is immensely profitable, at the interim stage, it made roughly 32 to 33 million Rand. You start applying a P of 8, which is highly beneficial, should I say, highly generous. That's the wrong word. 8, I think, is low. I'm going to tell it like it is. A fuel company in the UK is highly regulated. It's in the airports, it's in military bases, and if you want to move fuel around in the UK, you need permits until the end of time. It is highly, highly regulated. Argent bought these businesses during COVID for £1, plus the loan account of about £1.3 million. And I believed that if they were to sell that single asset, they would get back their remaining market cap. So just by selling one asset, which is 20% of their profit, and excluding cash, is equivalent to the entire market value of Argent Industrial. Will it happen? Probably not. But it's food for thought that despite the market thinking it knows everything, in many cases it doesn't. And you have to, as individual investors and as institutional investors like myself, to kick the tires and dig into the numbers and ask the questions, because in many cases, many of the underlying companies that power these small to mid caps are not separately disclosed. You actually have to ask management, where do these earnings come from? Why were they so good, or why were they so bad? For example, TWK, it was fertilizer, but that wasn't properly disclosed in the results. They just said that retail and mechanization were down, which doesn't indicate why they were down. It was fertilizer, which will rebound in the next 12 months. In Argent's case, most of the growth came from fuel and their offshore operations, but you would only have gained that by actually engaging with the company. So once again, I will say in closing, in this Christmas wrap, I was going to wear a Santa hat, but I don't think I look good in red and white. Any individual investor can actually do the legwork to ascertain as much information as any institutional analyst. It's just a question of digging through the reports and asking the right questions, and perhaps going to an AGM and asking the CEO or the CFO or an underlying divisional director, tell me, what is going on in this company and why was it so good or so bad? So I've given you a slew of stocks from Novus to Carp Agri to Afrimat, amongst others, which I think will benefit you as private clients in the next 12 to 24 months. I'm now going to have a look at some of the questions. And if I look in, it's because the writing is quite small. So give me a second. Okay. The first question, which I'm going to comment on, is what do you make of Signia's prospects now that Magda is back at the helm? How sustainable is its dividend yield of over 100%? Signia, for those who follow the company, is an asset management company, majority owned by Magda Wierzycka and her family. Asset managers have not had a great year. You've seen that from the results coming from Coronation and other companies. There is no net growth in assets under management in this country, aside from, offshore assets and innovation like ETFs, specialized funds, and funds coming in from the retail investor, of which Signia has been very successful in growing its retail base. It is unsustainable for a company to pay out 100% of its earnings in dividends. Last year, there was a capital distribution from memory, which bumped up the overall dividend stream. I remember, because I've been a Signia shareholder since the company listed, I think in 2014 or 2015. It listed on Magda's birthday. So I was very heartened at the large dividend last year, but I do not think it is sustainable. What we have seen in the last few weeks is the share price being unusually firm. For those that read my free page cover feature article on Signia, which I think was in June, I indicated that I believe there was consolidation coming in the asset management industry. I still believe that. We've also seen Alexander Forbes, the share price, have a nice run. I still believe that consolidation in the asset management sector has to occur. But as a Signia shareholder, I am very pleased at the dividend payment. And given that the majority shareholder likes dividends as much as I do, I expect the generous dividend policy in Signia to continue, but certainly not at 100%. Signia is a September year end. From memory, I think the results are coming out around the 6th to the 8th of December. I am not expecting the company to issue a trading update or a voluntary, tongue-tied. I think earnings on a year-on-year basis will be slightly weaker than the bumper earnings they showed last year, purely because the underlying fees that they earned from performance will be down in line with the market. But saying that, the growth in the innovative funds, the retail investor base, and the significant proportion of funds they have offshore, given the translation benefits of the dollar, euro, and pound, might see the market being pleasantly surprised at the resilience of the earnings from Signia. And I shall leave it at that. Here's a really good question. Any idea why Mustec is lagging? Last results seemed good. Mustec had its AGM a few days ago. I was on that call. So I asked the CFO and the CEO why the share price has been so weak. And it's amazing what you get from an AGM, which is why I recommend people actually attend them. The last results were quite good. You were spot on. The replacement cycle for PC hardware and infrastructure from a government sector should start to kick in the next 6 months. There are significant tenders currently out for adjudication, they tell me. The replacement cycle for those of us that bought new laptops and printers and bits and pieces during COVID, when we all worked from home, should start to kick in late 2024. So that cycle will start to kick in. However, for those that have looked at the Mustec results, the fastest growing division inside Mustec over the last few years has been renewable energy. The provision of batteries, which you can now buy to power your router or your TV or your light at home, or any form of small and medium enterprise operation or residential, and from solar. Any of you that have looked at the solar and battery market of the last few months will have seen it has become saturated. You can't open Instagram or Facebook or Twitter or any form of website without some deal for home power solutions, solar power being thrust in your face, and prices have fallen. And that's exactly what's happened in the companies operating in that space in the JSE listed sector. I was at a Roynet lunch on Monday, and they also confirmed that in the residential and the low end or smaller end business sector, they have seen a decline in revenue and in operating margins because of competition. And as they said, the fly-by-night boys dumping stock to try and generate profit to get out of the market. Mustec is in exactly the same position, where there's too much product in the marketplace. Solar has been saturated in the market that they target, and they have seen revenue declines and margin declines. So I am not expecting a good first 6 months from Mustec, purely for that reason. And it is for that very observation that I believe the market is extrapolating weakness into the Mustec share price, despite the fact the PE ratio is bargain basement. It's buying back shares. It pays a reasonable dividend. They are expecting materially weaker earnings on a 12-month view, purely because of what's going on in renewable energy and solar in what I would call the residential, and the small business sector. So Mustek, sadly, whilst it's in my top 9, and at one point was trading at 17 Rand 70, is now trading, I think, at around 13 Rand. But because of its tight liquidity, I do not see the share price collapsing too far, because the company will come in and buy back its own shares. Excuse me. And we mustn't discount, but as a small company, with the founder, sadly, David Can, having passed away early this year, and his family now controlling roughly 25% of the company, and the other large shareholder being Old Mutual, potentially people looking at Mustek as a take-out play, including management itself. So I will certainly suggest, but if I were to be writing a document into 2024 for take-out candidates that would be on top of my list, Mustek would be one of them. I'm looking here at Pascal shouting and screaming at me. So let me go through and just have a quick look. I've answered quite a few. Ooh, great question. Caxton v. Novus. That is a good question. I cover both companies, run by two very different CEOs. Terry Mullman, the sage doyen at Caxton, who's got stakes in Impact and his fingers in every printing and publishing pie. When you've got Novus with activists on board looking to grow the earnings, because if they grow the earnings, as the majority shareholders, they pay the money out to themselves. Both companies are trading at significant discount to net asset value. But Caxton is interesting because it's been trying to take out Impact, and it has been unsuccessful. And despite the share price having had a huge run, I had a buy on Caxton CTP in late 2021 at 4 Rand 25 with a 6 Rand 50 target, which it made, and is now trading significantly higher than that. And the underlying net asset value and earnings has improved materially. So which one would I want to be in? I would still say Novus, because the upside potential and the relative discount price earnings ratio, to me, means that once the institutions suddenly wake up and realize that this company can go from a loss to potentially a Rand a share and higher in 12 to 18 months, and is still trading on a PE ratio of around 4, and can pay out substantial dividends, given that the majority shares are owned by the activists, has a much better chance of capital appreciation than Caxton, which has already done significantly well. And we have no idea what Terry Mullman will do next regarding potentially continuing his endeavors regarding Impact and or other consolidation deals in the sector. So whilst I think both companies are good businesses, I have to look at what could make my clients more money on a 12 to 18 month view in total return in dividends and share price, and it would have to be Novus. And on that note, I've gone over my time. I'm sure that Gary and Pascal will ask me back, hopefully in 2024. It has been an absolute delight to converse with the people in the dark out there. This entire presentation at some point will be a YouTube, which Rand Swiss will put on its own website and its Twitter page, and I will relay that. For me sitting here in the dark in Cape Town, I want to wish you a peaceful, happy, successful, and prosperous festive period. No matter what faith and what creed you are, we all deserve peace and happiness in these troubled times. And lastly, given the market this year has been volatile at best, and we as citizens of a country that we beloved have endured trying times. Let us hope for 2024 will be one better for all living in this country. We have an election ahead of us, which will create a great deal of uncertainty. And I think that uncertainty will mean the market will be extremely volatile until the makeup of the governing party is set. And then whoever is in charge, be it a combination of the ANC and another, or perhaps the DA and another, that will determine where the rand will go, that will determine where the interest rate will go, and that will certainly determine the confidence of international money and the domestic institutions that drive the underlying valuation of a JSE. Currently, the JSE is at record low price earnings ratios for the very uncertainty that we as citizens and people who live in this country have seen. Failing government, failing infrastructure, and we can't even keep the lights on. I can because I live in Devouderkant. We don't get load shedding because we have a hospital. So I had to throw that in. But for everybody else suffering out there in the dock, we need some good news in this country. If good news comes next year with a government that wants to grow the economy, bring down unemployment, specifically youth unemployment, which is a crime in this country, wants to start lowering interest rates and improving the lives of the masses out there who scratch by every day, we have significant upside in the economy. But I do not see that happening until the elections are done and dusted. We know who is in charge and which individuals are running the key ministries, like infrastructure, electricity, Department of Trade and Industry, the Finance Ministry, etc., etc. So I would urge caution into 2024. And as a teaser, I would suggest that my portfolio of stocks, which I have selected into 2024, will err on the side of caution, will err on the side of quality mid-caps, and those businesses which have proven in 2024 that despite all the adversity, they can show earnings growth, they have balance sheet resilience, and despite the low price earnings ratios, if good times ever do come back to this country, they will hopefully show significant growth. From me here in Cape Town to one and all, a very happy, peaceful, festive period and a prosperous and hopefully successful money-making 2024. Take care all.